Alrighty, well, I like to be a punctual person, so everyone that's here on time, gold stars, we will get started. Welcome everyone to the Klaas U University for tax planning. There was a new tax bill that was passed recently, I believe back in July, so we have Jenny, our tax planning specialist, here to present a wonderful presentation on some of those changes that will affect you that you've probably heard swirling the news headlines and really want to get a deep dive on understanding how those affect your taxes for this year and going forward. My name is Nate Breiby. I'm a financial investment advisor representative down here in the Rockford office. Jenny is our tax specialist here on staff, which we are super excited to have her. She joined us late last year, and most of you may know that we do offer tax preparation and planning services. We'll be going into our second filing season next year, so we're super excited about those services. And then we have Eric Schmitz, another investment advisor up in our Madison office, joining us as well today. So we got three presenters here to kind of go over the tax bill that was passed, like I said, in July. So, Jenny, I will have you pull up your slides here in a second. Most of the names on this list we recognize, most of your clients, but for those of you who don't know about Klaas Financial, we are a fee-only registered investment advisor based out of Rockford, Illinois, and Madison, Wisconsin. We have 23 employees. We were founded in 1976, so we've been in business about 50 years next year, which is great. We primarily deal with retirement planning, helping people to retirement and through retirement. And obviously, a big thing that comes into play is tax planning. So we figured out that you've saved enough to retire, being able to efficiently withdraw funds from your retirement accounts in the correct order and minimizing taxes as much as possible is entirely relevant to your financial plan here. So, being a financial planning focused firm, tax planning is highly relevant to a lot of our clients. So that's what we're going to go over today. So, like I said, most of you are clients and have joined to start here, but just a couple of housekeeping notes. You will all be muted, and with your videos off, there may be a section at the end to unmute your line and ask live questions. At the bottom, you should see a Q&A, a question mailbox icon down at the bottom that you could type your notes. Eric will be monitoring those questions, and we'll pause Jenny to prompt her to answer any questions throughout the presentation. And I believe that is all the housekeeping items. We do record this as you've seen as you've entered the webinar. So Kristen will work hard on that within the next week or so and get that posted to our website. So I think with that, Jenny will pull up the slides and we'll start the presentation.
Thanks for joining us here today. Today's presentation is going to be about what's new in the tax law. The One Big Beautiful Bill Act, also kind of referred to as maybe by OBA, I like to refer to the acronym, is what passed on July 4th. Now, in my slides, actually, interestingly, that name was removed, I think, in the Senate, so it technically doesn't have a short name or a nickname right now. So in my slides today, you're going to see it referred to as HR 1, which is, I guess, technically its name until they come up with another better one for it. But today what we're going to do is look over, kind of discuss three categories of topics today. The first category or section will be what changes you can expect when you do your taxes that you won't have to do anything in order to reap the benefits of or be affected by. Those laws are just going to be built into the software, and your tax practitioner or you, when you do your own taxes, that stuff will just kind of be hard coded in the tax code. You don't really have to do anything in order for those effects to take place. The second section of the talk will be require a little more participation in terms of you as the taxpayer, what you need to do in order to take full advantage of the new tax law. So I'll review a few topics there. And then the final section today will be kind of a few of the more complex sections of the tax law that may require you working with an advisor in order to benefit the most from the new changes in the law. Okay, so a couple disclaimers certainly to begin with. The material that I'm presenting here isn't comprehensive. Let me move these photos here. It's not comprehensive. The tax law is much more broad than what I'm able to deliver here today. And even the topics that we have under discussion, I'm not going to be able to cover them exhaustively. So we'll just kind of give you the highest level talking points about a few of the items that we've selected. And third, interestingly enough, the tax law is extensive, and the IRS typically brings to bear their guidance starting in October, but the law is so extensive that there's going to be a couple years of rollout here. So even what we have today presented is kind of what we think is going to happen based on how the law is written, but sometimes when you think the IRS is going to zig they zag. So, and then lastly, everyone's tax circumstances are different. So while some of these things here I think you might want to take note of and ask your tax preparer about, I can't necessarily offer any specific tax advice or recommendations here today for anyone's specific circumstances. Okay, so for our first section, what changes can I expect when I do my taxes next season? The do nothing effects. I'm going to mention 4 things today. The first 3 bullet points I'm going to talk about in a little bit more detail on separate slides. Number 1, the permanence, in quotes here, of the Tax Cuts and Jobs Act, tax brackets and rates. So here I have permanence in multiple instances in the slide in quotes because basically what happened in a couple places is something that was set to expire now no longer has an expiration date. So it's quote unquote permanent. However, tax law is constantly being adjusted and changed. So these things are permanent just until they're changed again. The standard deduction, there's also quote unquote permanent changes that were made there with HR 1. There's a new tax deduction specifically for seniors, which I'll go over in a little bit more detail. And then the 4th bullet point here, I'm only mentioning it here. I'm not going to talk about it further, but there is an increase to the child tax credit. It currently is a $2,000 tax credit. Starting in 2026, that's going to go up to a $2,200 tax credit, and then it will be adjusted for inflation even beyond that in future years. So that's nice. It's never been adjusted for inflation before, so that was a nice change to see. The other thing that I want to mention here is the fact that this tax credit, I will be talking a little bit about credits and deductions. To start off here with a simple example, a credit actually ends up reducing a tax liability dollar for dollar. So to give you an example, let's say that when you do your tax return, you end up having like a $2,000 tax liability determined for your year. If you had a child under the age 17, a dependent there with a social security number, that would give you, let's assume we're in 2026 when this credit is realized. That would lower your tax liability all the way down to 0. And this is a refundable tax credit. So that extra $200 that you weren't able to use to lower your tax liability would then be refunded to you or mailed out to you in terms of a check or something. So it's refundable in terms of the way that the government is sending back to you, even though you didn't send any money in order to get this credit. You're getting some money back. That's what makes a tax credit refundable in some instances. Okay, so I've got a slide here that is quite interesting in my opinion. We're talking now about the fact that the tax brackets and tax rates have been adjusted under HR 1. So this chart interestingly shows 110-year history or so of the highest income tax rates. That's what's in the blue here. Over time, and then the lowest federal income tax rate is in the green. So you can see just by the extent of the way the lines are moving across the chart, tax law is continually changing. The number of tax brackets that we have and the tax rates associated with those brackets seems to be almost perpetually changed. The blue line here for the history of the highest tax rates, you can see in the earliest years it was under 10%. There are stretches of time where that highest tax rate was upwards of 90%. And conversely, the lowest tax rates have been close to 0. The lowest individual income tax rates have been is upwards of 20%. But if you look towards the right of this chart, we can see that for the past couple decades, those rates have kind of been a little more steady than historically we've seen over a longer stretch of time. So this blue line here indicates right here at this very end, it indicates the tax rate for the highest bracket right at the cusp of the beginning of the Tax Cuts and Jobs Act, which was the last really large legislation prior to HR 1 that really changed a lot of tax law. So that rate for the highest tax bracket dropped from about 40% to 37%. And then the lowest rate held steady at 10%. So what happened in 2018 is that the Tax Cuts and Jobs Act lowered the tax rate for a number of the brackets. Now those rates were set to expire after about 8 years at the end of 2025. So what's happened now in the new tax law in HR 1 is that it took away the expiration nature of a lot of those provisions. So we have what the tax brackets might have had a bump up in their rates, several of them at the end of this year. That's now been removed from the tax law. So we see a quote unquote permanence of the lower tax rates that went into effect back in 2018.
And Jenny, I think that's a really good point to highlight. There are some things that are really just a continuation of the Tax Cuts and Jobs Act, but then there are also new tax law as well that you will get into why I think it matters for people to be aware of both of those things.
There's a little bit of a story. I kind of have to go a little bit farther back in time in order to explain why some of this is the way it is, because a lot of what changed is really linked to legislation that passed back in 2017. Thanks.
And Jenny, the brackets in 2017 to 2018 Tax Cuts and Job Act, those all received roughly a 2 to 3% cut, correct?
It's not every bracket, but many of them, yeah, a couple percentage points here and there. Yeah. Yep, they went up. A lot of them went up.
Cut, yeah.
Yeah, they went down and they were higher in 2017, went down in 2018, would have gone up at the end of this year, but now they're going to be held the same.
Yep. And just, I don't know if you have this later on, Jenny, but just reading through the brackets, it's 10%, 12, 22, 24, 32, 35, and 37 are the different marginal brackets.
Yeah, thank you. Yeah, that's the case this year and next year now.
Yep.
Another big change, kind of in the structure of the tax code, or maybe the lack of a change, again, is what we're discussing, is that the standard deduction back in 2018, it almost doubled. So most people are given the choice of, everyone's given the choice of itemizing your tax deductions or using the standard deduction. Most people don't have enough itemized deductions that would result in them benefiting from choosing that type of deduction. So most people, upwards of 80% now, I would say, use the standard deduction. But that wasn't the case back in 2017. Here on this chart, we see that the standard deduction for a married couple was around about $13,000. The Tax Cuts and Jobs Act the next year, big increase there, made it about $24,000. Now that's been adjusted for inflation. So this year, 2025, before the HR 1 law passed, that standard deduction would have been $30,000. But as a result of HR 1, we actually got an additional $1,500 for the standard deduction. So with this deduction now being so high, relatively speaking, I would say approximately 80% or more of folks are able to take the standard deduction and get this large subtraction. I talked previously about a credit. Here, a deduction is a subtraction against income that is kind of added up or aggregated on your income tax return. So you get a large subtraction here that then is not included in your income tax calculation. So it kind of functions a little bit as a 0% tax bracket, you could say, so to speak. So the end result here, just from HR 1 for sure, is that these standard deductions would have previously were going to expire and revert back to their lower levels at the end of this year. But what HR 1 did was made these deductions permanent, quote unquote permanent, and actually topped them off a little bit more so we have a higher base amount, and these are also adjusted for inflation each year. Okay, so here in this first section, we're still talking about kind of the do nothing effects of the new tax law. So this is something brand new, a deduction for seniors. There was a lot of talk about no tax on Social Security benefits. You can see I didn't title this slide quite that way because as much as this the taxability of Social Security benefits was in the news, it actually didn't quite shake out in such a way that that could be a true statement anymore. Interestingly, Social Security benefit taxation hasn't changed, even though we've got this new tax law. There, as it turns out, there's no provision in HR 1 that makes Social Security benefits non-taxable. Still, many taxpayers aren't going to pay taxes on their Social Security benefits. So what gives? Instead, what happened is the law created a new tax deduction, and that's a $6,000 tax deduction, and it based this tax deduction based on age and income. So there's a new $6,000 tax deduction that you can claim on your tax return. You have to be 65 years old at the end of this year, or more, and it's only available for 4 years, and it doesn't coincide at all with your Social Security benefits because Social Security benefits are calculated based on adjusted gross income. This is a flat deduction that you can take on your tax return, and it doesn't take into consideration whether you even get Social Security benefits or not. So, for example, if we have a 70-year-old individual that is getting Social Security benefits, then they may be able to take this tax deduction. But if you're 62 and getting your benefits early, you're just not going to be able to be getting this tax deduction. I've got another slide here that's going to walk through an example that includes kind of the income phase out threshold. So in this instance, we're going to say that there's a 70-year-old single filer with a modified adjusted gross income of $90,000. Now the threshold for the reduction of this tax deduction begins at $75,000. So if we subtract that threshold from their adjusted gross income, we find that they're $15,000 over the threshold. Now, these phase outs and tax deductions each kind of has their own quirks or rules. For this one, it was just drafted that you just have to calculate 6% of the amount of your income over the threshold. So you just run the math. We get $900 in this case. And then we take that $900 and we subtract it from the $6,000 deduction possible. So for this individual, because their adjusted gross income is higher than the threshold, they would end up getting a $5,100 tax deduction as opposed to the full $6,000 tax deduction. This is a nice chart that kind of explains how the standard deduction relates to this new enhanced deduction for seniors. We've got in the dark blue here, a standard deduction based on a filing status. There already was an additional standard deduction for those that are over 65 or blind. So that is a $2,000 that was already in existence in the tax code. And then HR 1 created this additional tax deduction in green. So now a single filer with income, fully below the threshold would have in 2025 a greater than $23,000 tax deduction, where previously it would have been about $17,000. Okay, so in our second section in our webinar today, I'm going to talk about a couple of things that have been in the news quite a bit that also I think might require you to do a little bit of extra research or record keeping in order to see if these are tax benefits that you would qualify for, and to make sure that you would have the record keeping requirement met in order to take these deductions on your tax return. So I'll talk about in more detail what's been in the news as no tax on tips, no tax on overtime, no tax on car loan interest, and the expansion of 529 plans. And then only on this slide here, I'm mentioning 2 additional things. The CDCTC, that stands for a child and dependent care tax credit. So this is important, again, a tax credit being more powerful than a tax deduction. For those folks that have daycare or childcare expenses, maybe sending kids to after school sessions or summer camps, the math that goes into calculating that tax credit has been changed so it's a little more beneficial to the taxpayer. So go ahead and keep those receipts of expenses paid for those child care activities, and be sure to share those with your tax preparer, because beginning in 2026, those are a little more advantageous percentages or math for you. And then the last thing here, also in 2026, there is an additional itemized deduction for teachers, for educators. Now, there's no change. There's already in the tax law for 2025 and continuing on into the future, there's a $300 or $600 deduction for folks that take the standard deduction, that don't itemize, for any out-of-pocket expenses incurred, for teachers and buying supplies for their classes. But what's new is that there's an itemized deduction for the few folks that may itemize that doesn't actually have a monetary cap on it. So if you're spending, $800, $1,000, $1,500, whatever it is that you spent in the course of delivering your classes, keep those expenses on record as well, because that's coming in 2026. Okay, so we've got here, I've kind of grouped these 4 new deductions into this one summary slide because they're kind of a new category or an expansion of an existing category of tax deduction. The no tax on tips, no tax on overtime, and no tax on car loan interest. Those are nice sound bites, but at the end of the day, it becomes, it's not quite that simple. The no tax component here, interestingly enough, none of these things are excluded from income tax. What happened was tax deductions got created. So the tips, the overtime, all this stuff still is income that needs to be reported in the tax return. But what we're talking about here is that there's a deduction against the federal income taxes that would be levied on this type of income. It is not, however, an elimination of tax entirely for these categories of income. For example, tips, overtime, etc., still would be exposed to payroll taxes, which includes Medicare and Social Security taxes, and additionally, depending on the state that you live in, probably state income taxes. So it's unfortunately just not quite as simple or clear cut as some of the articles in the news might want to suggest. The other thing that these deductions have in common, well, you have to file a tax return in order to get these. Secondly, they do not lower your adjusted gross income. So there's a lot of points within the tax law that uses the figure of your adjusted gross income to determine some subsequent items. These deductions don't lower your adjusted gross income. Additionally, I think those are the main points that I wanted to talk. Yeah. Oh, and these all, I think, yeah, without exception, have an income threshold or an income phase out. So that's important, and it makes it a little complicated because the phase outs and thresholds are different, each of them usually to one another, and for many of the other phase outs and income thresholds already in existence in the tax code. Not making it easy on you here. So we'll go through the first one, no tax on tips. So this one is one of those temporary tax deductions right now, unless Congress decides to make a change at some point in the future. It's a tax deduction that only is valid for 4 years, 2025 through 2028, and it gives taxpayers a deduction against qualified tip income up to an amount of what we think right now, we think it would be $25,000 per year per tax return. Now, I know that people would start to be, their heads might be spinning about trying to shift more income to be tip income, and in order to get a larger deduction here. I want to let you know the IRS is already a couple steps ahead of you, and they're going to be coming out soon next month. They should be coming out with a list of industries in which tipping is customary and regular, and that's the income in those industries could potentially be included as qualified tips and eligible for this tax deduction. There are several trades that would be excluded. These are called specified service trades or businesses, and they include financial professionals, accountants, consultants, medical professionals. There's about 6 or 7 trades there that would not be able to be eligible for this tax deduction. And then also here, the IRS is explicit that these tips that would potentially qualify for this tax deduction, they have to be voluntarily given, they have to be determined by the customer, and not subject to negotiation. Additionally, they need to be reported. So the forms W-2 and 1099 will eventually have be overhauled so that there's a spot on them for qualified tips. The IRS has come out recently and said that they're not going to institute those changes for the 2025 tax year. So this is a point where you as a taxpayer might want to think about keeping those pay stubs and creating some documentation for what has happened throughout your tax year in order to talk with your tax professional about being able to claim this tax deduction.
The one other thing that I will add to this is that when it comes to those who have a self-employed business, qualified tip deductions are going to be limited to the net business income. So that's going to be any gross income, and then you would have to subtract any business-related deductions after that.
Thank you. Yep. And yes, so there is a way to report, even if the documentation on the W-2 or the 1099 doesn't show the qualified tips now, there is a way on the tax return to be able to show those tips and then get the deduction. Yes, and that's also going to be true for those self-employed folks as well. So thank you, Eric.
So just from this is obviously a deduction on the federal level, just so everyone understands that. So potentially in Wisconsin and Illinois, where the bulk of our clients are, if this was, relevant to you, that would still be taxable to those respective states, along with FICA taxes, payroll taxes. So that's why Jenny puts these no tax on tips in quotation, because that's still 2 of the 3 layers of taxation, payroll tax and potentially state tax on this tip income. So the other thing I want to say on these provisions that phase out over a 4-year period, a good critical thinking question to ask is like, well, why is that? And, when bills like this are passed, they're usually large. Tax cuts cost money. You have less revenue flowing into the federal government. So, some of these can be viewed as kind of pay-fors to reduce the headline cost of these bills. If you offer a deduction or something like this for only a period of time, it's a lot less expensive when you're scoring a bill over a 10-year period rather than making like a permanent reduction in tax brackets, right? That is extremely expensive to say, on all this income, you're paying 2 to 3% less permanently versus you can deduct this income for 4 years, right? So that's kind of how that it has been viewed too, as kind of a way to reduce the overall cost of the bill.
Thanks, Nate. And that's also true for this no tax on overtime and the subsequent one that I'll be talking about, no tax on car loan interest. These are really just addressing deductions to your federal income tax, and don't apply to the Medicare and Social Security tax that this income will need to be exposed to. Yeah. So the no tax on overtime, I have an additional slide on this one to run through a calculation, because I know for me, when my husband works overtime on Saturday, I'm figuring his entire day Saturday is considered overtime pay. But the way that IRS has already given us a little bit of interpretation of this part of the law, and I'm going to go through a slide next about how this is actually calculated, the qualified overtime, what that actually is going to mean. But looking at the tax deduction from a little higher vantage point, you're going to be able to subtract up to $12,500 on your tax return per taxpayer. So if you have two individuals filing jointly, that could be potentially a $25,000 deduction for the entire tax return. And then that overtime pay is going to need to be reported on your W-2 or 1099. Again, there's no change in the forms for 2025. So this is where you might want to do a little bit of better record keeping before you meet with your tax professional. And on my next slide here, I'm going to talk about what they consider, quote, qualified overtime. They've chosen a definition of basically it's the half portion of time and a half compensation, or potentially the double part of double time. So in this example, I've got Jane that worked a 50-hour week, which included 10 hours of overtime. She's paid $20 an hour. So her paycheck that week is calculated as 40 hours at $20 an hour, and then she worked 10 hours at $30 an hour because it's time and a half pay. So for the purpose of this rule, qualified overtime is just that $10 an hour of her half of her time and a half pay. So in this paycheck, she's working 10 hours of overtime, and the premium above her regular rate of pay of $10 is the qualified component. So that's $100 of qualified overtime for her in that week's work. And then multiply that over, assuming she does this for 52 weeks of the year, her tax deduction in this case would be $5,200. And that eventually will be recorded on a W-2 coming the end of 2026. All right, the fourth and final and kind of our new category of tax deductions in HR 1 is this no tax on car loan interest. So there's a very large tax deduction here, a potentially $10,000 tax deduction, far larger than what most people would be able to utilize for the interest paid on a passenger vehicle purchase. So now this tax deduction is only for new vehicles bought since January 1st of this year. The new work that you're going to have to do is you're going to have the VIN number, because that's going to need to go in the tax return. And you'll have to double check that your vehicle had final assembly in the United States. There's quite like 5 or 6 more requirements here. You can't buy or be in this isn't for business use vehicles. You can't be buying and selling scrap or salvage vehicles. There's a whole bunch of other components to this one. But basically, a person who's bought a brand new vehicle in 2025 could deduct the interest on the loan that they used in order to finance that vehicle. So eventually, the GMAC or whoever has financed the vehicle with you will be sending you a report at the end of the year that shows how much interest you paid in that tax year, so that you can keep that information and use it to substantiate this tax deduction. And it also has an income phase out, same as the last 3 that we've been talking about.
Do you have to itemize for this deduction?
That's a good question. You do not. For this and the previous 3 deductions we talked about, you can take the standard deduction. You do not need to itemize, and then you could still get this tax deduction.
Yeah, the enhanced senior tax deduction do not need to itemize. A deduction for tip and overtime income do not need to itemize, and then car loan interest do not need to itemize for that deduction.
Yep, that's correct. There's going to be substantial changes to the Form 1040 and the supporting schedules, I would anticipate, because we've got kind of a little subset here of things that are more similar than dissimilar. So I'm curious to see how they'll change the forms, and those won't be available for several months yet. All right. And lastly, in this section, we've got an expansion of eligibility for the 529 plan. There has been, I think, a doubling of the cap for annual distribution. It goes up to $20,000 per student starting in 2026. So there's some expansion in the categories of those disbursements can be used for, including tutoring costs, fees for standardized or admission exams, things of that nature. And then additionally, there's this other section here called post-secondary credential expenses. So for those already active in a certain profession, any fees that they have for exams or continuing education that they incur to maintain a credential are also eligible expenses out of 529 plans. So these are some exciting changes, I think, in the world of 529 plans, and I think you too spend a lot of time talking about these types of accounts. Oh, you're muted, Eric.
Thank you for that, Jenny. Hey, there's one thing that I would add to this, which is the fact that any expenses that have been incurred this year before or after the bill passed, which Jenny, you can correct me if I'm wrong, but I believe it passed on July 4th. Any expenses incurred this year before or after can be reimbursed from 529 plan accounts just as long as the distribution occurred this year. So that's just something to note if people were trying to figure out, which expenses count and which ones don't if they've done a reimbursement on both sides of that date.
Yeah, thank you, Eric, for that. All right, now for our last section of the webinar today, we're going to talk about what tax planning opportunities exist because of the new tax law. Now, these maybe are a little more complicated or require looking at more than one moving part in your tax situation, which is why I've included them in this section, because you'll probably be most benefited by working with a professional in order to see how you can maximize these components of the tax code. So first, we're going to talk a little bit about the flexible spending account. Then we'll review the estate and gift tax exemption, the SALT, the state and local income tax limitation. There were big changes there, and also to charitable contributions made starting in 2026. I'll mention here just briefly, I'm not going to talk about them further, maybe unless questions come up, but there's some energy credits that are expiring. Many energy credits are expiring very rapidly. Everything related to electric vehicles, both tax credits for previously owned electric vehicles and new ones that have been bought this year, those credits will expire at the end of this month. So if that's something that's important to you, I would act fast in order to use those tax credits for any of those vehicle purchases you might be interested in. And additionally, also about energy credits, for a while now, we've been used to being able to deduct, to get a tax credit for energy efficient upgrades to our homes, like energy efficient windows, doors, or heaters, that sort of thing, insulation. Those are also expiring at the end of this year. So 2025 would be the year in order to make talk with your tax professional and make any of those upgrades there, because in 2026, those will not be tax credits available to folks anymore. And then Trump accounts also, there's a lot of moving pieces about the Trump accounts. You're not going to be able to make contributions even until the middle of 2026. So there's just, I think, a lot of question marks about those still as yet. So we weren't going to discuss those any further today. So I'll move into flexible spending accounts next. So for 2026, no changes in 2025. But the annual maximum contribution for a flexible spending account, the DCFSA at the top stands for Dependent Care Flexible Spending Account. That increased substantially by a 50% increase there. So those are still use it or lose it accounts. That nothing has changed in that regard in terms of these flexible spending arrangements. But the nice thing about these accounts is that the amounts that you're contributing are excluded not only from gross income are excluded from gross income on your W-2, meaning that you're not only saving on income tax, but you're also saving on those payroll taxes, the Social Security and Medicare tax. So as an example, the same amount of income in 25 and 2026, contribution limit is higher because of HR 1. Assuming the same tax rate, the tax savings, you can get an additional over $700 of tax savings because this type of account, it reduces three types of taxes there. So potentially, if that's an account that you're using great. You're going to be able to realize this tax savings by increasing your contributions, or it's maybe something that you might want to think about if it's available to you through your employer.
And just to clarify, FSAs are obviously different than HSAs, health savings accounts. So there was some talk, I believe, Jenny, about maybe expanding the HSA contribution limits and things like that, but I don't believe any of that got included, correct, in HR1?
Nothing in terms of the way that it's structured, other than I think Eric can inform us about an increase in the eligibility of certain healthcare plans.
In the original version of it, there was going to be a lot more changes to HSA eligibility. But the final version limited a good amount of that. So I would say the two biggest things that have been expanded with HSA eligibility have been treating all ACA bronze and catastrophic plans. Those are now all considered high deductible health plans. And you're now eligible to make HSA contributions while enrolled in what's called capped direct primary care arrangements. In the past, you were not allowed to do that, but you can do that now.
Switching over, I guess, to estate tax exemption. This is another section where I have to kind of dip my toe into the past a little bit, because back in 2018, the gift and estate tax exemption doubled because of the Tax Cuts and Jobs Act to about $11 million per person. And then it has been adjusted annually, increased, so that now it's about $14 million per person by the time we arrived in 2025. This is one of those provisions that would have expired at the end of this year, and it was set to decrease to about 50% of its 2025 level in 2026. So what happened with the new law, HR1, is that this snapback or this was eliminated. So the larger exemption rates are now maintained, and additionally, HR1 reset the amount for 2026 that the gift and estate tax exemption at the federal level will be $15 million per person in 2026, and will be continue to be adjusted, but with inflation the years after. All right, our next topic here are the state and local taxes limitations. These are increased. This is instead of a quote unquote permanent change to the tax law, we've got here a temporary increase in this limitation. So here we're mainly talking about state and local or city taxes, as well as property taxes. So what happened now, it's effective in 2025, that limitation, which was $10,000, has now increased to $40,000 this year, and will go up by 1% each year through 2029, and then it's going to snap back to the previous level of $10,000 unless Congress makes a change. And I've got it. My next slide here is going to show that there's quite a bit of tax planning that could potentially be accomplished for those that are going to be affected by these limitations. Because the interesting thing is, as your income rises, for example, what we're looking at here, this green line, is the limitation for single head of household and married filing joint taxpayers. And then the blue line here, we have the phenomenon, the limitation for married filing separately. But if we look at this green one here, we can see that income starting at a modified adjusted gross income of $500,000, there's a limitation here that $40,000 cap is reduced as your income increases. So it's fully phased out. This limitation actually drops back down to the $10,000 threshold once $600,000 of modified adjusted gross income is realized. So there's a lot of consequences here in terms of tax planning as income increases across this phase out, that could potentially mean quite a bit higher effective marginal income tax rates, even up close to about 45% marginal tax rates as a result of the way that this tax law is written. So this is definitely a planning opportunity. And for those that are in this income range, for each of these filing statuses, it would be worth discussing with your professional.
Just add just a little color on that too, Jenny. Like this was extremely important to a lot of those in Congress and higher tax states, like namely Illinois, to like honestly get their votes to pass this bill. This was pretty much a must-have that salt cap was needed to be increased from $10,000. Back in the past as well, Jenny, that was part of Tax Cuts and Jobs Act to put that salt cap in effect, I believe, as well. So this was one that they've been looking to redo for years just to get members of Congress in higher tax states, to get their residents of those states, those congressmen and women to, vote for the bill. This is pretty much a must-have. The question was, well, how high do you increase that cap, not if? So it's definitely going to happen to get the bill passed, which it has, and they settled on $40,000 there for a period of years here.
Yeah, and this then would be, we're talking about folks that then would be itemizing here. We're not talking about folks that then would be optimized under using the standard deduction. Yeah. All right, and I think one of the last topics here are the changes to our deductions for charitable contributions. So this slide, everything on this slide is starting in 2026, and there's no sunset on these provisions. So for those that take the standard deduction that are not itemizing, in 2026, there's going to be a new deduction that you could potentially take on your tax return of $1,000 or $2,000 for married couples filing jointly. So this is after this, it doesn't require that you itemize. So you would still, even if you're making cash contributions to your church, for instance, you would be able to get up to $1,000 or $2,000 tax deduction where there hasn't been one. There isn't one like this in 2025. And this is something that's kind of like hopped on, hopped off the tax return over the past 8 years. Certainly during COVID, there were years where it was something like this, $300, $600 was on the tax return, then it was off. There's been a lot of change in terms of getting deductions for these charitable contributions. So it's nice to see something that maybe has a little bit of longevity now being available for taxpayers. The caveat, though, in terms of this tax deduction is it's not for non-cash contributions. That means old clothing, old pots and pans, whatever it is that you're donating to Goodwill that isn't cash does not qualify for this tax deduction. It's just monetary contributions. And then separate from that, for taxpayers that do itemize their tax deductions, what HR 1 did is that it maintained the 60% limit of adjusted gross income. That previously was at a 50% level before the Tax Cuts and Jobs Act. At one point in COVID, I think it was up to 100%. There's been a lot of fluctuation in this number as well. But going forward in 2026, it'll be back to, it will maintain the 60% AGI limit on cash contributions. And interestingly enough, now there's a new floor for 0.5% floor of your adjusted gross income for those that itemize, that your charitable contributions have to get above that floor in order for them to be deductible. So what does this mean? In an example, we could say that a taxpayer that has $100,000 adjusted gross income, they would have a $500 floor. So if they've given $2,000 to their church, the first $500 would not be deductible. They'd have to that would have to be set aside, and then the remainder of their contribution would then be a tax deduction for them, assuming that they're benefited by itemizing their deductions. And then the last bullet point here, I'm not going to go into much detail, but for taxpayers in the highest income tax bracket, that 37% marginal tax rate, their deductions are going to be limited a little bit to bring them down to be able to realize those deductions at more the 35% tax bracket level.
Just to amplify what Jenny said, so starting in 26, like cash contributions, like Jenny said, so you go to Goodwill and you donate a dresser and they say, do you want a receipt? Like that doesn't apply here. That doesn't really help that, at all actually. But you giving $2,000 to your church or your university or wherever, generally in the past you would say, well, I don't really have enough deductions to itemize, don't send me a receipt. Starting in 26, you'll want to receive those and keep those for your records because you do not have to itemize for this $2,000 married filing joint, for example. Now, a lot of our clients, it's not in the deck here, but a lot of our clients are aware of qualified charitable distributions. Most likely that's still going to be more advantageous to continue the QCDs, I believe, Jenny, because that's above the line versus below the line for this one, I believe. Oh no, they're both above the line, right?
Yes, the QCDs are above the line, meaning that they're going to lower your total income that's exposed to the taxation calculation. And for this one, I guess technically we haven't seen it yet. I would think that
No.
it would be below the line, but I guess we just really don't know yet. But I would think it would be a below the line deduction after your AGI is calculated.
So that would be something that obviously working with us and Jenny, we would determine, how best to allocate that. If you have charitable intents in a QCD, in excess of your minimum distribution, for example, that's where this may potentially be relevant, to maximize kind of both deductions, if that makes sense. So, and I just laugh in the tax code to this 0.5% AGI floor. It's just like unnecessary complexity in my opinion, but that's, it's just what it is. But anyway, keeps Jenny's job interesting, I guess.
Unnecessary complexity. That's interesting.
This was fantastic. This was a really good amount of information that you were able to share here. And with some of the time that we have left here, this is where we're sort of opening up our Q&A session. So if anyone has any thoughts or questions that they would like to share, please go into the chat button that is towards the bottom of your screen and feel free to share. While some people are thinking about some questions and send them in here. One of the things that I think a conversation like this highlights is the fact that tax planning, thinking about all of this stuff, is not just something that you can do one time a year, right? It's something that you have to consistently think about throughout the year, whether that's just talking with your spouse or just talking with your household about what you have to do, or whether that's meeting with your whether it's your financial planner or your tax planner to figure out, hey, what are the moves that I have to make this year to save the most amount of tax possible and not pay penalties and basically keep as much as my income as I can, right? But Jenny, I'm curious, what is one of the biggest things that you would say to the average person that would come up to you and ask, hey, what are some of the biggest things that I can keep in mind when I'm doing my tax planning? It's a tough question. It's pretty broad.
I guess probably, reach out to your tax professionals sooner than later, especially in a year where so much has changed. Because, yeah, your individual circumstances, it is a complex situation out there. And these different tax deductions and credits, you can't really just get a sense for how it'll shake out in your individual circumstances. It really requires a professional to help you work through with software in order to see what would be the best outcome for each person. And though our circumstances change every year, we have this tax return that we have to submit every year, a reconciliation process basically. So each year our circumstances are different, our life changes, and so does the tax code. It's a lot to keep up on. So I guess I've seen too many folks come into my office and offices of my colleagues where they didn't reach out in advance to a change that they're making. They didn't reach out in advance to their tax professional about changes that they're making in their life. And then it's quite a bit harder to kind of backtrack. We can change things after the fact, usually, but it's usually a little more painful to do so after the fact.
Sure. Nate, do you have anything that you would add on to that?
Just that each tax year is different, right? I mean, so your circumstances change, and sometimes some of these you may phase out from the senior tax deduction in one year, for example, because you're taking a large distribution, and the next year it may become available. So each year your taxes could look completely different or be relatively similar, and that's our job as your financial planner is to map that out for you and kind of show you where you're at this year and do some accurate forecasts as to what the future looks like, as to when to take distribution, what accounts to distribute from, and all that fun stuff, we definitely have the knowledge and expertise now with Jenny and our software that we purchased to really do a pretty darn good job of mapping that out for our clients. So.
I would say one more thing. Be mindful of where you get tax information from. I actually just got an email from the IRS yesterday talking about the amount of penalties that they've assessed in the past few years because of people following advice that they saw on social media from people that really don't know about tax or just trying to get a certain number of followers or whatever. And then you're the one signing your own tax return. So at the end of the day, if you've claimed deductions or credits that you're not entitled to, you're going to be responsible for those penalties and whatnot if the IRS finds out after the fact, just because there's usually a cross-referencing or checking that happens of a lot of the data in your tax return. So be careful who you're getting your tax advice from. And just because you think that somebody else is getting a tax deduction, it may not be true, and they may not be an adequate source of information about these topics.
That's a really, really good point. Yeah. I think we got one question here. Let's see. Question. If you are above the SSN deduction level, is there any easy way to get back down to try and take advantage of that? That is the question there, Jenny.
Wait, can you read that again? On the SSN deduction level?
Yep. Yep. If you are above the SSN deduction level, is there any easy way to get back down to try and take advantage?
I would interpret that maybe as enhanced senior tax deduction.
I believe so. So this is talking about Social Security specifically.
Oh, okay. So if the income is higher than the threshold for that enhanced or new senior tax deduction, what can you do in order to qualify for it? Yes, so that tax deduction is based on your age, which is not much we can do there about our ages, but the income there is based on modified adjusted gross income. So there may be some options that we could do, whether that would be deferring income depending on the types of income in the tax return. There may be ways to add certain tax deductions or deferring income into a different year in order to bring you closer to being able to qualify for that tax deduction. So some tax deductions would be through potentially payroll tax deductions. I'm not sure if you're still working or not, or contributions to different retirement accounts that can happen maybe outside of a compensation. We'll have to look at that specific situation in more detail, but adjustments to your adjusted gross income then would be the way to see if we could get you to qualify for that tax deduction.
If this person is still working, traditional IRA deduction potentially if he's not covered by our plan through work with phase out ranges, HSA, even that FSA that Jenny talked about, through your payroll, that's a good way to do that too. If he's over 70 and a half and has IRA money and subject to minimum distributions, doing a qualified charitable distribution would reduce that AGI. Not as relevant for most of our clients, but tax loss harvesting, if there's losses in stocks held or securities that we manage, being able to utilize some losses potentially, but that's only limited to $3,000, Jenny. So I guess that's not a huge.
The issue too that you can run into is if you just have too much income coming in through guaranteed income streams through a pension. Unfortunately, with those pensions, you can't just tell them to stop and not send it to you. So in cases like that, your taxable income will just naturally be behind. Although there are some ways to reduce it on the aggregate, it is very tough when you have very high guaranteed income streams, often through a pension or just simply high Social Security income as well. So, yeah. But no, I thought this was fantastic, Jenny. You did a great job going through all this stuff. To your point, this is really, really complex stuff. So thank you for doing your best to simplify it down and giving us a good education today.
It's my pleasure. Thanks for having me today.
To Nate's point, this will be recorded, and then our team will then put it on our website along with sharing to everyone who attended today's webinar. So if you have any other thoughts or questions, feel free to reach out to us, and we'll be more than happy to answer them for you. Okay. All right, everyone, have a great rest of your night. Thank you, everyone, for being here. Nate, Jenny, and Krista. Thanks, guys.
Bye. Thank you.
Thank you.